Welcome back, everyone, to another episode on Living Your Greatness. This is your host, Ben Mummy. And the goal of my show is really simple: to learn from those who have mastered their craft at what they do. If you're new to my show, please be sure to hit that subscribe button. Today, we have a new guest to the show, and his name is Adam Taggart. He is the CEO and founder of Thoughtful Money, a show that offers practical insights from top wealth experts to help you reach your financial goals. So, without further ado, welcome to the show, Adam.
Hey, Ben, thanks very much. It's a pleasure to be here.
Let's kind of get kicking here. Tell us a little bit about your origin story. What inspired you to want to interview some of the greatest wealth experts in the world, especially in, finance and economics?
For those that aren't familiar with Thoughtful Money, which is the financial media company that I run, primarily a YouTube channel, though our content is in a lot of other platforms as well. It's really designed to help the regular investor become better educated, better informed, so that they can make more intelligent decisions around how to build their wealth. Long story short, the mission of the company is to help people fund their life goals, pure and simple. Regular people, we don't, our education system does a terrible job of teaching financial literacy. I mean, it's crazy, Ben. What's the reason why most people go to school? Well, you go to school because you think it's going to give you a leg up in succeeding in life. And for most people, they equate that with, I'll make more money if I go to school than if I don't go to school, right? And yet our school system completely fails when it comes to teaching people about wealth building, about financial literacy. And so it's just sort of assumed that we throw a ton of information at you, and it's just sort of assumed that when you go out in the world, you're going to know how to manage the money that you're starting to earn. And what happens is most people, you get out in the world and feel incredibly insecure about how to be captains of their wealth, of stewards of their wealth going forward, because they were just never taught how to do it. So that's kind of the big driving reason why I created Thoughtful Money. And so the origin story that kind of put me on that course was my parents got divorced when I was very young. I don't even remember them living together. And my father was a doctor, and my mother got custody of my brother and I. And growing up with her, she didn't have too much of a formal education. She didn't have a lot of good role models in her life, particularly around money. Her parents had died young. And so she didn't have a lot of people helping her make good financial decisions. And so she honestly made a lot of really poor financial decisions growing up. So in our house, money was just always a stress. It was something that we always just felt the lack of, and a lot of stress around. So anyways, long story short, I went to college. I got my degree there, but I also was pre-med, and I was going to go off to medical school. And right around the time I was about to graduate, this was in the early to mid 90s. This is when the Clinton administration started revamping healthcare, and every doctor I knew said, hey, they're ruining the profession. Don't go into it, or at least don't go into it now. And so I found myself deciding not to go to medical school, which had been the whole plan, and I had to figure out where else to go. So I wanted to go to some place where I could, get a good experience, get some good real world knowledge. And they had these financial analyst programs on Wall Street that were pretty competitive to get into. And I'll tell you, it was pretty hard to pivot from pre-med to finance, but I managed to do that in my last year of college, and ended up going to work on Wall Street for Merrill Lynch as a junior investment banker. And when I was there, I got kind of a front row seat as to, how the financial world works, but basically how Wall Street works for its own interests, not for its clients. And personally, and I'm not casting aspersions on anybody that works there, but the culture was just not a fit for me. So I knew that I didn't want to spend the rest of my life in that type of environment. And so I ended up leaving after my analyst program was over, and went to Stanford Business School. Really trying to find a place in the world of business that would feel more like more in tune with my values and how I was wired. And while I was there, the internet revolution happened. And so it was pretty easy to go into an internet company coming out of there. So I went to a startup that ended up getting bought. And from there, I went to Yahoo and ended up joining Yahoo Finance as its head of marketing. And that's where I really began kind of blending my background in the financial world with the media space. And ended up spending almost a decade at Yahoo. Ended up there as VP of Marketing for North America. And while I was there, Ben, we saw the blowing of the well. First, when I started at Yahoo, that was right at the bursting of the dot-com bubble, right? So I saw the destruction that an asset price bubble could do. I spent most of my career at Yahoo between 2001 and 2009. So I saw the emergence of the second asset bubble, right, the housing bubble. And at that point in time, my wife and I were starting a family. And so we were looking to buy a starter home in Northern California where we live. And we finally found the lowest price starter home we could find that wasn't a complete teardown in Menlo Park, California. And when I asked the realtor about it, he said, "Well, if you want it, that it was listed at $800,000, and I couldn't believe that such a crummy home was worth that much way back then." And the realtor said, "If you want to get this house, you're going to at least have to bid over $100,000 over the asking price." So uncomfortable with that, Ben, but I did, and I was so far outbid they didn't even invite me to counter. They just said, "Nope, somebody else came down with a lot more money. We've sold it to them." That happened to me one or two more times. And I just said, "Look, I'm missing something here. I just got this expensive degree at Stanford. I'm a relatively smart guy, but I don't understand why people are willing to pay so much for homes right now." So I went online and I started researching the housing market, and I found my way to some voices. They were the minority, but these were the folks warning about a housing asset bubble. And what distinguished them from everybody else, from kind of the mainstream analysts, or the mainstream people who were cheerleading the housing market back then, was that these guys had real data. They had historic data, and you could see, these long trend lines that all of a sudden were diverging like crazy from their historic trends. And they were just saying, "Look, it's this is clearly an asset bubble that's being blown. It's likely going to end in tears, like these always do." And of course, it did. So fast forward to the end of my time at Yahoo, right around 2009, 2010, I just couldn't get up and go to work, keep getting up and going to work to try to get one more person to use Yahoo Mail or one more person to play Yahoo Fantasy Football on their phone. After what I had just realized of what had happened to the economy, where so many people basically walked into the great financial crisis because they were cheerleading the housing price bubble. They were cheerleading what was going on in stocks, and they lost a ton of their net worth in the correction that happened after that. I realized there was a much bigger opportunity to marry what I learned about the financial world and what I'd learned about digital media to get out there and educate people at scale about really the real trends that are happening in the financial world, so that they can make smarter decisions. And the next time that we see excesses in the marketplace, that at least they can be aware of them and they can be taking that into account as they're making their wealth building decisions, and hopefully not get caught unawares like so many people have been in the past. And honestly, a huge part of the populace still is, because they don't pay attention to this stuff. So that's when I got the idea to try to create a financial education platform. I've created a couple before. I've created Thoughtful Money. Thoughtful Money is the latest and greatest iteration of this process. But anyways, that's a little bit of a long-winded exposition, but that's how I ended up creating the platform that is now Thoughtful Money, and why I get up in the morning and why I do what I do. What I want to do is just make sure that more and more people have a better understanding of the true forces that are driving financial asset prices, that are driving the economy, so that they have a better chance of hitting their wealth goals and having the kind of lives and lifestyles that they want, and then also reducing their vulnerability to being caught unaware by one of these inevitable crises that happened because, in many ways, I think because of bad policy. And sadly, maybe we can talk about this in a bit, Ben. But I think that there are growing risks that there may be another corrective event in our future. And again, I want to make sure that whether indeed it happens or in what timeline it happens, that as many people as possible are paying attention and have positioned themselves so that if it does happen, they're as least impacted as possible.
Absolutely. Well, I appreciate you, sharing your origin story. Becoming financially literate is super important. And so a follow-up question that I have is, how can someone go on the right path to becoming financially literate?
Well, the first thing you got to do is just start getting educated, and that's the good news is that's easier than ever these days. There are some classic books out there if you're a big reader. Intelligent Investor by Benjamin Graham, Random Walk on Wall Street. It's just pretty easy to find your way to the classics here. But there's lots and lots of free information now available on the internet. And you and I are talking, here on a podcast. Podcasts are wonderful. They're a great way just to start, really just jump in and start listening. It's one of these things where you might not understand every term that's being used by the guests. At Thoughtful Money, one of the things I try to do is I bring on the expert. My goal is to bring as much of help them tell their full story in whatever way they can best tell it, and then I try to, where needed, sort of transcribe their economic speak into regular person language, just to try to bring as many people along as possible. But even if you don't understand every term that's being used, again, you're there on the internet, so you can just go do a quick Google search, and over time, you're going to begin to learn the terminology. You're going to begin to recognize concepts and patterns. And if you find it interesting, and I think for most people, the more they learn about it, the more interested in it they get, because it's very explanative for how the world works. Your learning curve, increases at sort of an exponential rate as you go along here.
I understand from what you said, being a continuous learner, seeking information, but there could be a lot out there. So obviously seeking the right information. What lessons have you learned from learning about the history of money? And do you think we're experiencing a perma crisis right now?
So let me give a quick plug for a great free series on the history of money. There's a fellow named Mike Maloney, who runs a company called goldsilver.com. He has created a series called The Hidden Secrets of Money, which basically Mike literally traveled around the world with a film crew, and went to, many key places in the world where, in centuries, millennia past, developments happened in terms of money, when the first, strips of precious metals were used as a medium of exchange. He goes to, the Federal Reserve and talks about the creation of the Federal Reserve and why that happens, and then discusses about how we actually make money in the US. And what's interesting is this is definitely one of those topics that our education system just doesn't tell us about us at all. I think if you stop people on the street, 99% of them will not be able to tell you how money is created in the US. It's just sort of something we take for granted. But anyways, I think from understanding the history of money, what history shows us is basically, for commerce to thrive, you need to have trust between parties, right? You need to have a way for them to transact in a way where both parties, basically trust that they're getting value. And a lot of times you need that intermediary for exchange, right? Because it's not convenient to bring all of your oxen down to the marketplace to sell one of them to somebody else, right? So having this trustworthy medium of exchange is critical for many different reasons. Precious metals have largely proven themselves to be the most trusted form of currency and money throughout the ages. The advent of paper money, obviously added a huge convenience factor that sort of led to an explosion of the ability to do commerce. Now in the modern era, we have digital ways to share existing currencies. We also have some new currencies out there like Bitcoin and whatnot, which we can talk about a little bit later if you want to. But the key thing about them all is that there has to be sufficient faith in in the currency, both as a means of transaction, but also as a store of value. And what history basically shows is that every dominant monetary regime that we've had has generally ended because the currency was abused and people lost their faith in the store of the currency store, in the currency as a store of value. And I think that's particularly germane to know now because I think we are in a regime, a monetary regime, where pretty much all of the main world currencies, in fact, all of the main dominant world currencies, are now unbacked, or what's called fiat currency. Not all that long ago, historically, they had some hard backing. They were tied in many cases to gold. People have heard the term the gold standard, right? The US started going off the gold standard in the 20th century, and then in 1971, President Nixon famously severed the dollar's ties to gold. And so since then, the only real limiter on money creation has been humans' ability for self-control. And if you understand human behavior and human nature well, you know that that's not a very great restraint. Humans can always rationalize reasons for why they should do things that are in their self-interest. And so I just did an interview on my channel a few weeks ago with a former Federal Reserve executive, Thomas Honig. He ran the Kansas City Federal Reserve, and he was actually a voting member of the Federal Reserve Open Market Committee coming out of the Great Financial Crisis. A really interesting guy. And I asked him directly about this, that we've just experienced this. Well, certainly if you look at even the purchasing power of the dollar since the creation of the Federal Reserve back in 1913, it's lost something like 98% of its purchasing power. And we've seen a tremendous loss in the purchasing power of the dollar and many other world fiat currencies since the COVID crisis, because we issued trillions and trillions of stimulus out there into the world, and that basically put a lot more dollars and yens and euros out there into the world, and so the purchasing power of each one of those has gone down commensurately. And of course, anybody that's lived through the past 4 years has, with the spike that they've seen in their own cost of living, they know exactly what I'm talking about here. So I asked Dr. Honig about this, and he lamented. He said, yeah, he said, once we went fiat, we put the control of our currency's integrity into the hands of mortal men, and history clearly, recent history is clearly showing that it's not a good limiter. And he said basically, if we don't go back to some kind of backing, he sees an inexorable decline in purchasing power of the dollar and all the world's major fiat currencies. And to hear this being openly admitted by one of the top people ever to sit on the largest and most important central bank in the world, to me, was really nothing short of shocking. I mean, it's not that I disagree with him, but even somebody who has been that close into the system thinks that same way too. So that raises all sorts of questions for us as just regular people, which is, well, gosh, what can we do to prevent against that continued erosion in the purchasing power of the currencies that we earn our paychecks in and transact in?
Something that I'm curious to ask is, you talked about ways to, protect our wealth right now with gold or even Bitcoin. So a question I have for you is, how do these asset classes come into play right now, especially with, inflation being really high?
Sure. Let me first say, look, what I'm talking about, is not something that is going to go. The dollar's not going to die tomorrow, right? This is going to be a process, and in fact, it'll be a long process, for highly likely. And I'm not encouraging everybody to liquidate their dollars tomorrow and just buy bricks of gold, right? That said, I do think gold plays a really prudent role in most people's portfolios. But really, I think, and again, so this is largely why I created Thoughtful Money is there's a lot going on in the world, in the economy, in geopolitics that impacts you know, the individual person's ability to build wealth over time. And I want people to be aware of those developments. Again, that's why I created Thoughtful Money. As I say a lot on that channel, information is useful, but it doesn't really have any value unless you take action based on it, right? Unless you take informed action based on those insights. So yeah, it begs the question, okay, so what do you do? How do you actually protect and preserve your wealth? And I think for most people, just getting down to brass tacks, there's three things you got to focus on, right? You got to focus on your ability to earn, you got to focus on your ability to save, and then you got to focus on your ability to invest. And depending upon your age, your current net worth and whatnot, some of those are going to be more important for you than others. If you're younger in life, don't worry so much yet about investing. Really work on creating your potential to earn money, earn an income, and then focus on how to save as much of that as possible, right? But when you get to the investing stage, that's where your money hopefully can start to work for you. But really, your number one goal on the investing side is just to at least keep up with the pace of inflation. Right? The number one goal of the investing side of the equation is to just prevent your wealth from getting eroded over time by inflation. So you want to put it in things that are going to be inflation protected. And primarily, those are things that are either that have intrinsic value that can't be inflated away, and precious metals, are an example of that. But remember, precious metals don't generate a return, right? They don't put money in your pocket. It's really truly a store of value. And so, stocks actually can play a really good role in inflation protection if your stocks are growing appreciating and paying dividends, if your collective return is higher than the rate of inflation, right? So at the end of the day, first and foremost, you want to meet or beat inflation with your investment capital. Now, investment capital over time also gives you the opportunity to try to generate excessive returns, and if you can do that, great. Of course, that pushes you further out the risk curve, and depending on how much risk you want to take, that's highly dependent on your personal situation. We can get a little bit more into how to decide that later on in this discussion if you want to. But pretty much the general cohort of asset classes still makes sense in the investing world, but you got to look at it through the lens of inflation. So, for example, like real estate, that's a great investment. Depending on its price to value, right? Like right now, I can make an argument that a lot of real estate especially residential real estate, is overpriced, right? So this may not be the right time to buy. But if you buy at a good value, real estate investment's wonderful because it's a hard asset that pays you income, and it's income that is inflation adjusting. As inflation goes up, you can raise your rents. And it comes with all sorts of tax advantages as well. So, it's hard just to pick sort of one asset class that's going to be the be all end all to protect us. In fact, that's highly likely not going to be the case. If you read some of those classics I talked with you about, diversification is a huge part of the story here. But the end goal, like I said, for investing and building wealth sustainably over time is first you got to make it, then you got to keep it, then you got to protect it from inflation.
So then I have a follow-up question then. I like the fact that you talked about all the different areas, of making money, then saving it, then investing it. So if we were to think right now, if we had a situation of, someone that is a millennial that they're tuning in and, they have saved money. So they've earned money, they've saved it. And now they're trying to figure out in today's times, how to invest it properly. How would you, advise them, or even if it wasn't just to advise them, what have you learned from top wealth experts of how they could diversify their money?
Great. It's a great question. So, if you are just starting your investment career and you're younger, right? So millennial or Gen Z, right? First, good news is you've got the most valuable asset on your side, which is time, right? And I'm sure most people watching this are at least generally familiar with the concept of compounding, right? And that's one of the things that your investing career will do for you is it'll compound your returns over time. So the longer a timeline you have, the more opportunity you have to grow wealth through the magic of compounding. I'd say some lessons I've learned, both from my own experience and sometimes from the School of Hard Knocks, but also through the folks that the many folks that I interview on my channel. And by the way, I interview a lot of very high profile, very highly successful and seasoned experts. So, I just mentioned I had a former Federal Reserve official on the program. I have people that are, managing multi-billion-dollar institutional funds. I've got top analysts. I've got, I've had people who are, top CEOs. And while there are all sorts of strategies out there, that if they're successful, you can make a lot of money. When I talk to them, they really do say, if you've got time and you've got the ability to, keep yourself relatively disciplined, that there are time-honored ways to make enough wealth that are pretty simple. And it's really just a matter of just getting started and just being consistent. And so Chris Brightman is a fellow who I've talked to a couple of times, and he's the chief investment officer at Research Associates. And their research influences just trillions of dollars in Wall Street capital. And he's happy to talk about what he thinks at any given time, looks attractive in the marketplace. But he says, look, for the vast majority of people, he said, if you can start out in your 20s or early 30s, and you can put $1,000 away a month, and yeah, it might take you a while in your 20s to work up to where you can put that much away. But if you put $1,000 of your money away every month, and forgive me because I'm not remembering the exact 10 asset buckets that he had, but usual suspects of U.S. equities, U.S. bonds, global equities, global bonds, a few other different asset classes, all can be done through simple ETFs. And he said, if you put $1,000 every month into that, and what you do is every month you look at the performance of each of these 10 ETFs from the previous month, whichever one underperformed the most, put your $1,000 into that one. And so what you're doing there is you're trying to sort of use reversion to the mean to your advantage here. So you're using time, you're using dollar cost averaging, and you're using reversion to the mean, which is, hey, this asset had an underperforming month. It's probably going to hopefully overperform at some point going forward. You just keep doing that for the next 25 years. By the time you hit 50, you're doing just fine. You've got a million and millions of dollars at that point in time. And then he says, and then when you retire, you just flip it around. Every month you take out a contribution, 1,000 or more, depending upon how much money you have at that point and can afford, and you pull out of the one that performed best over the previous month. And you just keep doing that, until the day you die or until you've spent it all. But by that point, that should probably pretty much carry you through the rest of your life. And that is basically kind of as brain dead and simple a process as you can get. And it doesn't mean that you can't, in addition to that $1,000, as you make more and more money, that you can't be investing in other things as well and creating even a further diversified portfolio, or leaning into asset classes that you think are particularly undervalued at some point in time. But as long as you do that $1,000 a month in those 10 ETFs as he's describing, you've already got yourself financially set, right? And then everything else above that is gravy and just trying to live an even better life financially.
You just shared some wisdom that you've learned, but you've done so many interviews on thoughtful money. You've met with people like, Michael Spence or David Rosenberg or Glenn Alden or Stephanie Pomboy. When you think about all your interviews that you've done, I know it's hard to choose one favorite, but what is a memorable interview that stands out to you?
Gosh, well, I'm going to say that Thomas Honigwood is one that I think just anybody should watch, because right there you're getting so many of the people that I interview are trying to anticipate what our monetary and fiscal decision makers, how they think and what they're deciding. Honig actually sat at the table. He's been there. So, everything that he told us is not conjecture. It's because he was there, in the machine with these people. So it's a really unvarnished sense of just sort of truly how the power center of arguably the most important institution in the world that affects everything, but certainly our economy and our pocketbooks functions. And Thomas Honning's a really nice guy. He answered all my questions very directly, but in very sort of easy to understand, regular folks speak. So I highly recommend that folks check that out. The Michael Spence one is sort of near and dear to my heart because it was the first interview I did when I launched Thoughtful Money. Michael Spence is a Nobel Award-winning economist. He won the Nobel Prize for economics, but he was also the dean of my business school when I was at Stanford Business School, right? So actually, have a little bit of a personal connection there with Mike. He's a really nice guy, and one of the things, so he talks about Dean Spence is the least alarmist person I think you could find in this world. And he ended up writing a book with Mohammed El-Arian, who used to run the bond book at PIMCO, and is looked at as one of the smartest people on Wall Street, certainly, I think, in all cases, but certainly when it comes to bonds. And they also, the third co-author of the book was a former prime minister of the UK. So pretty big power group writing this book, but it was all about the perma crisis that they see us heading into. So I think if you're trying to understand from a very big picture, the big themes that are going to be driving the world going forward, I think that's a really good video to watch. But the reason why I'm mentioning it here mostly is because at the end, I talked with Dean Spence about one of my memories from Stanford Business School that really stuck with me. And when we were graduating, everybody worked hard while they were there, and we were all going off to our new careers. And Dean Spence just sort of made himself available for a question and answer with the class. And somebody asked him, they said, "Look, I've got these two job offers, and one is like totally in my skill set. I know I can crush it. I can make a good deal of money there, but I've done it before. And I'm actually more interested by this other one. It's in a new industry that I haven't been in before, so I'm going to have to get up the learning curve. There's a little bit of uncertainty there. We're going to have to move to take the job, and my wife and I are thinking about starting a family, so I'm going to have that in the mix. And I'm curious, Dean Spence, what do you think?" And he said, "Look, my life experience has told me that if you want to succeed, you should lean into risk, right? If you don't take risks, you don't win big." He said, "But I'm always very cautious about how many risks I take at once. I really try to take them in serial if I can versus taking them in parallel." And to the student, he said, "You got to make up your own mind, but you're kind of telling me you've got these sort of three big risk factors you'd have to deal with all at once with this, the one that's exciting you versus the other track seems like, the risk profile is a lot lower. You get to decide, which of those two, is right for you." But I've used that a lot in my career, where when I've looked to go after opportunity, I've always tried to see, can I manage the risks involved with it and put them into serial versus having to tackle them all head on in parallel. And I think that is if you can do that successfully, I think your odds of hitting your goals goes up pretty dramatically. And I don't think most people think through it in that much of a structured way. But risk is the pathway to reward, but you've got to really make sure that the risk reward ratio is a smart one for you.
Absolutely. Yeah, no, I think that's valuable. Question that I want to move to next, kind of shifting gears here. Charlie Munger, I think, had a great impact, as a leading, investor mind in the world, and
No doubt.
he was big on, his speech there from 1995, the psychology of human misjudgment, where he explains behavior economics and, how they can be applied to business and investing and just life. And so a question I have for you is, what are mental models that stand out to you that help you make better decision making? Because I know you're big on decision making.
Yeah, well, okay, so I did the big one, which is don't take on too many risks at once. So one thing that I see people maybe work against their own self-interest. So I love this field of behavioral economics. And one of the things that fascinates me about it is you would you would expect humans to be very good with money because it's so quantifiable, right? It's all cut and dry. It's just math, right? Humans are terrible with money. And it's because our emotions get involved, and it's because we're human animals, right? So it's amazing all the different ways that we can sort of sabotage ourselves, or that we can get taken advantage of, or of people who sort of know, the mental hacks, the mental ways to hack us. And there's some phenomenal work that's been done by a guy named Robert Cialdini on that. Have you ever read his book Influence, Ben?
No, I haven't actually.
I highly recommend that to all your viewers. It is a fun read, but he basically goes through kind of the most, what he says are the key, I think it was 6, I think it's now 7 principles for how we get influenced as humans. And once you understand them, you can really start seeing them in the world in a way that you couldn't before. And marketers, politicians, these get used against us all the time. And he says, even as sort of the expert of this, he knows he still falls prey to this stuff, every day, because a lot of times it's just happening at a subconscious level. But anyways, it's a little bit of a digression. But if folks are looking to self-educate, Cialdini's book Influence is a classic and super valuable. But when it comes to investing, what I find that people do that oftentimes self-sabotages them is they glom on to a particular investing thesis, and they say, but I really think this is going to happen, and therefore I'm going to put my entire portfolio, into that bet, into either first derivative or second derivative applications of that bet. And the honest answer is investing's hard. Even the professionals don't get it right a ton of the time, right? Just like a great Major League Baseball batter, is somebody who still, misses 2 out of every 3 swings, right? So as regular, for your regular sort of armchair investor, where you're trying to make your stock picks, while you're focusing on your regular job and your family and everything else going on in your life, you're not going to have as many wins. You're not going to have as high a win percent ratio as these institutional experts. So, but nonetheless, people will listen to podcasts, they'll watch CNBC, they'll read the Wall Street Journal, whatever, and they'll get a general sense of, oh, okay, I think this trend's going to happen. Like right now, inflation is sticky, right? So, everybody or a lot of people are coming up with, their portfolio allocation for sticky inflation, right? And inflation may stay higher for longer than initially expected, or it may not. We don't really know at this point in time, right? There's nothing wrong with having that as your primary thesis, but you don't want to be putting all of your chips on it, right? You want to make sure that you still remain pretty well diversified, and that you certainly have either hedges in place or a plan in place if your primary thesis turns out not to be correct. And the vast majority of investors don't do that. They're kind of all or none investors when it comes to strategies. So I would highly caution folks to avoid that. And then also, headlines are highly deceptive. I say this as a guy who runs a financial media channel, so I understand sort of the irony of this. But if you're consuming information, first I'll understand that most things are nuanced, and they require a full understanding to really come to a correct conclusion. And way too many people are just reacting to the headlines that they see, right, or the little blurb that they saw on TV, right? That tends to be what shapes their thinking. And highly recommend that folks shouldn't do that. 1, because you're not getting the full story. But 2, you really have to consider the source of the information that's coming to you. And I just had a pretty long discussion on this yesterday. Let me give you a couple of examples. So Fed Chair Jerome Powell, right? He, at the end of last year, he surprised the markets by after having spent the whole year saying we're not even close to even thinking about rate cuts, he came out and said, oh, rate cuts, yeah, we're totally thinking about it. In fact, we're probably going to do several next year, right? And that lit a fire under the markets. That's why the first quarter of this year, the stock market went bananas. And Powell's reason for admitting that was, or for saying that, was because he said, look, we're getting close to our 2% target and we're confident we're going to get to it. And we don't want to wait until we get to 2% to start cutting rates, because then inflation might get too low because of the momentum that's bringing it down. I don't know about you, Ben. I don't know too many consumers that would cry about too low inflation for a little while, but that's a separate discussion. But there's another, school of people that were thinking, there aren't a lot of good reasons for Powell to be cutting at this point in time, especially while the economy is still running hot GDP wise, while unemployment is low, while the stock market's, hitting all-time highs. And, they began thinking, maybe he's actually not confident. Maybe he's actually afraid. Maybe he's afraid that, the fact that we've raised rates as high as we have, and we're hanging out now with rates this high for as long as we have, that important systemic things are starting to buckle under the weight of these higher interest rates, right? And we don't know. We don't know for sure. Time will tell. My point is, though, is that the Fed chair is never going to reveal that he's worried about something big, right? So, like, if he was afraid of us going into a recession, he would never say, you know what, I'm starting to cut rates early because I'm afraid we're going into recession. Because if he said that, immediately everybody would start reacting to the fact that, oh my gosh, the Fed's worried about a recession. I got to start curtailing my spending, preparing for harder times ahead. And it would become a self-fulfilling prophecy, right? So, a lot of times people will say, well, why are you worried about a recession? I just listened to the Fed chair. He says everything's great. Well, like I said, you got to consider the source, right? There are certain things that certain people or certain mediums are not going to tell you. Similarly, I get a lot of people who come to my channel because they want a deeper conversation than what they're getting, say, on TV financial news. But a common complaint I hear about CNBC is like, wow, those guys are just eternal stock market cheerleaders. And really the reason for that is when you ask yourself, well, how does CNBC make its money? Well, they make their money through advertising. All right, well, which advertisers pay them? Oh, the big ETFs like BlackRock, the big ETF packagers like BlackRock. And so, because of that, pretty much no matter what happens in the economy or what happens in the market on any given day, the anchors are going to spin it into a great way they're going to spin it that, oh, well, that means it's a great time to buy stocks right now, right? Stocks going up, well, it's a great time to buy stocks because there's momentum. Stocks going down, well, it's a great time to buy stocks because they're on sale, right? And the reason for that is just, that's the financial incentive they have for the type of business model they have. So my point is you just always have to consider the bias of the information source that you're listening to. And like I said, I think way too many people, sadly, they just don't. They just hear the headline, they just hear the soundbite, and then they use that to make some sort of all-in-one bet in terms of how they're going to position themselves. So those are two big things that I really encourage people to protect against. And one last part about this too is most people forget this, especially when you get caught up in an emotional mania, and that's really been driving the markets a lot, particularly recently. To the upside, at least, has been FOMO, right? As stocks entered 2023, when everybody thought there was going to be a recession, that didn't show up, and then the stock market kept going higher and higher and higher. Everybody began realizing, oh my gosh, my neighbors who bought Nvidia, last year are making a killing. I got to get in, and so the stock market went up like 25% from October 2022 to end of last month. That's huge. It's a huge amount in such a short period of time. And that was largely driven by, people's emotion. And what we forget, and the science is really clear on this, is humans experience the pain of a loss twice as much as they experience the joy of a gain. But what tends to happen is when FOMO really starts kicking up, people forget that, they jump on the train. And then if they end up, truly buying into what may have been a mania, well, reality sets in, price is correct, and that people have the hangover afterwards of like, why did I do that? Because I just lost a lot more money than perhaps I could even afford to lose. And that's the point where they really realize and they really feel the fact that they feel that pain of the loss twice as much as the gain. But that's not what's driving their thinking up until the whole house of cards come down. So again, I really encourage people when they get started on making an investment decision, they ask themselves, okay, look, yes, this could go up. How will I feel if it does? But if it goes down, how will I feel? And if I can live with that, great, make the investment. But don't just make it because you're caught up in the exuberance of the moment, which sadly way too many people get to.
That's why behavior economics and just investor psychology, I think, is so important. I'm huge on that. I really advocate for it. I think there needs to be a lot more, I think, maybe knowledge or even just like education on that aspect. Because I think we see, the average investor isn't a professional like themselves, to actually know, how to manage those emotions, right?
Yeah, and if I can chime in on that again, because you have an audience that's a little bit younger, so they might not have, right, a lot of market experience yet. So the sort of three things I want to build off of. One is knowledge, right? So again, read as much as you can, listen as much as you can to podcasts like this. Try to be the sponge before you're really putting serious money at risk. Try to be the sponge and try to learn as much as you can. Then you want to get experience, right? Experience is how you learn. And usually as an investor, you learn from the school of hard knocks, right? Oh my gosh, I didn't stick to my position sizing on this one, or I wasn't diversified enough, or I should have dollar cost average instead of just putting all my money in, all my chips in on day one on this, or whatever, mistakes you made. The market will definitely punish you for your mistakes, and you'll hopefully, become smarter as that goes along. Once you've got some knowledge in there, start trying to get some practical experience, but recruit the experience of those that have gone before you. And this is something that I don't think enough young people do, which is to seek out a mentor. Seek out people. So in the case of this goes for anything in life, but in terms of investing, identify people that have been investing for a long period of time, hopefully been successful at it. Take them out to lunch, help them get to know you. In most cases, they are more than happy to transition their knowledge to the next generation of investors. People like to be helpful when they can be. But ask them, what were some of the best investments you made? Why were they so good? What were some of the biggest mistakes you made? What do you wish you had known when you were starting off in your investing career? Because you want to be able to stand on their shoulders and avoid the avoidable pitfalls that they fell into because they didn't know better. But now because they're telling you about it, you can sidestep a lot of this stuff. And it also really helps too, as you're getting started, to have an experienced eye look over your shoulder at your decisions. Try to find an investor that is willing for you to say, hey, look, as I make my trades, do you mind if I just let you know, so that you can just give me any feedback on it? That can be hugely useful in terms of beginning to think how they think. And that just acts as a catalyst for your progress on this journey. But a lot of times too, they might say, "Are you sure you want to make that trade? Because this is the worry I would have," right? And they might actually help you rethink some things. So yeah, combining that experience, that knowledge, your own experience, but then accelerating it with the experience of those who are already seasoned as investors. I think it's a really winning combination.
I agree. And I'm actually happy that you brought that up because there's a lot of research that supports what you just said in terms of any skill set of becoming an expert or getting good at something. And
Mhm.
so there's a book called The Talent Code, and they talk about early exposure. So learning something maybe at a young age or getting that experience over years. And then another aspect is also being deliberate with your practice or your craft or what you're doing. So if it is investing in this case. And then another thing which you had already just talked about is mastering coaching, whether that's through mentorship or a friend or a network or a community. So I really appreciate that, Adam. And so who are some of your greatest mentors that you would like to talk about?
Oh, golly. I'm very fortunate on that part because I sort of get to create them as part of my day job. I get to talk to all these fantastic people, and a lot of the times I get to uh, as we get to know each other, I get to have really fascinating long conversations with them, or we swap stories. Um, as I look back on my career, I didn't get it from my family, and I'm going to guess that probably most viewers feel the same way. And one thing I just want to say is, if that resonates with you, like, oh gosh, I wish this was the type of stuff that my parents had told me about. Don't worry, you're not alone. That is by far the common experience. But I'd encourage you to try to make a commitment to yourself that as you step into the role as parents, you start your own families, you have your own children, that you do play that role of financial educator, financial mentor to your children. Hugely important. And as I think probably the majority of your audience is feeling right now, they would have benefited from it had their parents done it for them. So part of this is really trying to break the cycle of unpreparedness of folks entering adulthood without this background. You talked about early exposure. That really starts in the home. But let's see. Let me try to think of some of the folks that I talked to a lot. I just interviewed Michael Pinto yesterday. He's become a really dear friend. Lance Roberts. These are people whose writings and analysis you can find all over the internet. They're very smart in and of themselves, but they are also capital managers. They run financial advisory firms. So I always really like to talk to people who are smart, who are analytical, who are data-driven, but who, at the end of the day, they can't just rest on their opinions. They have to put client capital to work. They have to demonstrate performance of successful wealth building over time. So people like that are hugely, I consider, I'm very lucky to have in my life. I've had people like Danielle DiMartino Booth and Stephanie Pomboy, who are again super smart. Danielle DiMartino Booth was she was an advisor to the Dallas Fed, so she's got a lot of inside baseball in terms of decision making at the Fed as well. Lacey Hunt is one of the world's greatest living economists. I run a twice yearly conference. Lacey keynotes that every year. He gives a graduate level presentation in terms of where the economy is headed, and I'm like hanging on by my fingernails as he gives it, because it's so academic, but it is like he's the best of the best in terms of understanding the economic theorems that drive the activity in the real world. And Lacey's such a generous soul. He's such a great man from his accomplishments and his work. But like I've spent time in Texas with him at his house, just hanging out and hearing his stories from interacting with the greats, with Paul Volcker, with Milton Friedman. He knew all these guys. He was contemporaries of theirs. I mean, I could literally keep going on with more and more names. I guess the one thing I'd kind of underscore in all this is when I started out, when I first started my first channel that interviewed people like this, I was a total nobody. None of these guys knew me. And what I learned, and this is something I hope your listeners take to heart, is there's that old expression, six degrees of separation, right? That if you want to get to somebody, you probably know somebody who knows somebody who knows somebody, and you go through 6 degrees, and you can eventually find somebody who'll connect you with who you want to get to. In the modern era, it's more like 1 or 2 degrees. It's really not that difficult to reach these people. And you'd be amazed if you reach out and ask, hey, I'd like to, would you mind terribly spending 10 minutes with me? I've got this question I'd love to get your thoughts on. Most cases, these guys will, if they can, they'll drop what they're doing and they'll help you out. And that applies if you're trying to knock on the door of one of these big names that I just mentioned. But it totally applies to other people in your own lives. You work at a company, there's the CEO or somebody up at the top that you feel, oh, he'd never talk to me because I'm just a rank and file employee. most of the time they will if they can. And having the courage and the proactivity to just knock on the doors of people who you think you can learn from, if you can develop it, it's a superpower. Because like I said, the vast majority of times you knock on the door, it's going to get answered. And kind of go back to that old Michael Jordan expression, you miss 100% of the shots that you don't take, right? If you want to get smarter and you want to leverage the knowledge, the connections, the goodwill of those who are successful, if you don't knock on their door, you're not going to get it.
Totally. And I echo a lot of that. Like my first guest that I ever brought on this show was Jay Martin, and I had been watching his show for maybe 3 years, and I had just reached out to him, just being like, hey, I'm trying to have impact on, like the next generation in terms of overall health and wellness. Like, you want to come on the show? And yeah, within just one, message out, there was an answer right away within, a day. Yeah, let's make it happen. So no, I'm glad that you shared that. It's so true. I think people should always believe that if they're looking for mentorship, it's more than just one email away. You know what I mean? Like, it's so close to them. So I appreciate that, Adam. And Adam, from your tribe of mentors, because you shared a lot,
Mhm.
what do you believe separates, a good investor from a great investor?
Oh, let's see. A good investor from a great investor. One is certainly humility. I would say some of the most successful people that I talk to just exude humility. That look, at the end of the day, we're all just still trying to figure all this out. I think those who get too impressed with their own intelligence, they tend to be stuck in the good investor but not great category. Obviously, being very data driven versus dogma driven. Being very disciplined. I can't remember you were talking about one of the models earlier. I can't remember what you said, but it's sort of like continuous application. Um, uh, definitely hedging, right? So those who have an insurance policy in place for if my main thesis is wrong, that seems to be something all the greats do. Another success factor that I see them have is they marry their logic with some sort of unbiased discipline. And so a lot of these guys have a practice, right, which basically it's like a set of rules that they always follow, right? And this might be like position sizing is a really good discipline. And if you have NVIDIA is a great example of this. If you had NVIDIA in your portfolio over the past year or two, if you started out with NVIDIA at 3% of your portfolio, very quickly it was 6%, and then it was 9%, right? Because it just kept growing, right? And great investors, they know that outsized returns like that don't last forever. And so what they'll do is called position sizing, where they determine, okay, how much of a percent of my portfolio does this position deserve to have? And if it grows above that, periodically, we're going to harvest those gains to get it back down to what we think it should be. And so kind of the casino equivalent of this is you're just increasingly taking winnings off the table. And eventually at some point you're playing with house money. So no matter what happens to the position, you're so far up, you almost don't even care what it does because it's already treated you so well, right? And what that prevents you from doing is getting too dependent upon a position that you fall in love with, and it goes from 3% to 6% to 9% to 20% of your portfolio. And then, as tends to happen often with something that's moved that big, that fast, there's some big corrective event. And all of a sudden, you've got a big gaping hole in your portfolio that you weren't protected against. So there's that. But also folks like Michael Pinto do a really good job of this, where he spends a lot of time investing in his analysis of where he thinks the economy is headed and what he thinks is likely to happen next. But he has this model that he's developed, and he's got dozens of inputs that go into it. And the model basically tells him, what investing conditions we're in. Are we in disinflation? Are we in stagflation? Are we in deflation? And if he thinks that we are headed towards a new phase, I really think we're going to be going into stagflation next. he uses the discipline of the model to, if the model is still telling him, nope, we're in disinflation right now, he either has to abide by the model until the model says, okay, yep, it's stagflation, game on. Now you can, start allocating your stagflation trades. Or he has to come up with some really compelling reason to override what the model is telling him. Sometimes people do this. Lance Roberts does that at his firm he's got a co-portfolio manager. And basically it's almost like a nuclear missile where both guys have to turn the key at the same time. So no one of them can determine how to change the portfolio strategy. So, having that kind of control where no matter how strong your convictions are, you've got some sort of, unbiased or counterbalance that keeps you in check so that you don't get too starry-eyed by, whatever might be driving your convictions at that time. Most of the great investors that I know do that. And Charlie Munger and Warren Buffett are great examples of that, where they've got I'm sure it's a lot more complex than they make it sound. They make it sound sort of so simple in terms of the criteria that they use, but they just don't deviate from it, right? No matter how passionate they get or how, sizzling the sexy storyline is, and some potential acquisition they could make, if it doesn't hit their checklist, they just don't do it. So having that kind of cool-headed, unbiased discipline, which is hard in a very emotional driven arena like the markets can be, that's definitely a critical success factor too, to get to great.
Absolutely. Yeah, no, those are some good ingredients. And Adam, the purpose of my podcast really is to inspire people, to achieve greatness and enhance their overall personal well-being. So what is your definition of greatness?
Oh, yeah, I'm going to go back to kind of the mission of Thoughtful Money, which is to fund your life goals, right? Which is, I think greatness is really just accomplishing what you set out to do, whether it's financially or elsewhere in life, whether it's in your relationships, whether it's with your health, whether it's, particular accomplishments that you want to make in whatever your particular area of passion is. I think greatness is working to, create the mastery and having the discipline and having the vision to just, put that cocktail all together and work at it until you've actually crossed the finish line. And yeah, I think in a lot of cases, most people partially achieve what they set out to do, if they're being honest with themselves. I think those that actually cross the finish line and literally say, yeah, I had this objective for myself and I went and I got it 100%. They're the rare breed that brings that cocktail together and keeps at it until they've crossed that finish line. So whatever it is in your life, and I guess one important thing too is, this is a whole other discussion, but one of the biggest challenges that I hear from people of all ages, but certainly hear it from the younger generations, is, God, I'm really having trouble answering the question, what should I do with my life? Like, a lot of people it's another shortcoming of our education system, but a lot of people have, a lot of trouble really trying to zero in on their purpose. And if you've listened to my videos on my channel, you've probably heard me say this before. If you go to YouTube and you search for centenarian advice, centenarians are people who live to be 100. So there's a bunch of videos out there, and they sit down with these 100-year-old people and they ask them, okay, so you've done it, right? You've done life. Like, what really matters? And it's really interesting, Ben. They all pretty much say the same three things. They say relationships. Quality relationships is number one, which just goes to show you that as humans, at our base, we're social creatures. And that's what really matters to us, are meaningful relationships. Number two is purpose, that like my life mattered in some way that's meaningful to me. And then number three is pretty self-evident. It's health, right? Can't live to be 100 if you don't have good health, right? So I think if you're really like leaning back and saying what really matters in life, what should I really be investing my energies in? It's those three things. But the purpose one is the one that most people really have a lot of trouble with. And you talk to most people, the research it's pretty depressing. It's something like 80% of people, I think it's over 80% of people, if you ask them if they could have the ability to change careers and be doing something different than what they're doing right now, they would say absolutely. Like, totally don't want to keep doing what I'm doing right now. And that's because, again, our education system doesn't do a good job of helping with self-discovery. So people end up going into professions that their parents encouraged them to go into, or that their peers were going into, or maybe those were the companies that were hiring at that point in the economic cycle when they graduated, right? But they find themselves a couple of years, a decade or two down the road, and they're saying, "Wow, is this all I'm going to be doing for the rest of my life? Because I'm not loving it." But at this point, I feel kind of stuck. That's why a lot of people kind of have the midlife crisis there, because they feel confined in by where they find themselves, right? So I think a great or an essential part of kind of getting to greatness is to really doing the inner work and inner investigation to say what's really important to me, so that when you're setting your goals to determine what finish lines you want to cross, they're really ones that are appropriate for your values, for your passions, for what you want out of life.
I really respect that definition of greatness. And your pillars that you just spoke about remind me of like ikigai, right? Having a purpose, doing
Yeah.
something that you love, doing something that you're good at, doing something that's purposeful, right? So no, I really respect that, Adam. And something that I want to ask you, now that you have a good feel of my show and what it's all about, who's someone that you personally know that you love to see on this show?
Oh, that's a great question. Um, I love your questions because they're not just laser focused on the economy and how do we make money. You operate at a higher cerebral level than that. Um, let's see here. Of all the folks that I talk to, uh, I mean, every weekend I do a weekly market recap with Lance Roberts. It's one of the names I mentioned earlier. And they're long interviews, long discussions, and we spend the first hour talking about the markets and the economy. And again, we could spend 5 hours talking about that. There's no shortage of stuff to talk about. But we really kind of trundle in the last half hour off into just kind of life advice. And I'm not sure exactly what started it. I think there was just one day something was weighing on one of our minds, and we just wanted to kind of bounce the idea off the others. But what we found was that it really resonated with the viewer audience, in particular with the millennials and Gen Zers that watch. And the feedback that we got was like, wow, like, we don't get this type of kind of just general life advice from two guys that have lived long enough to have some opinions, and some informed opinions. And there just aren't that many forums for us to kind of get access to this information. If our parents aren't sitting down and giving this to us, or we don't have a really good mentor, this is the type of life advice we want. We just aren't having these conversations. So Lance would be a really good guy to both deliver any questions you want to ask about, what makes for a good capital manager, because that's what he does for a career. But also, I've just had years now of bouncing, all sorts of life issues, life questions, life observations off of him, and just batting him back and forth. And I know that he's a great mind and a font of not just knowledge but wisdom on those issues.
Well, I really appreciate, you giving Lance's name. And, I want to take this last little bit of time, to really, thank you for being here. But most importantly, also, I want to make sure that I connect my audience to where to go to find your work. So where can they go? And is there any last words that you want to add to this conversation afterwards?
Sure. So first off, folks, if you're interested in when we talked about sort of gain your knowledge, then gain your experience, and then get a mentor, I think my channel is a really good channel to consider in addition to Ben's here, on the knowledge side of things. So as we said, I do 4 interviews a week. I interview top money and market experts from around the world, top economists, top money managers, top analysts. And my job, like I said, is to really bring out their full knowledge, and then when necessary, translate it into sort of regular world speak for the average person. So if that sounds like something that'd be useful for you, then go to thoughtfulmoney.com. That's my website. There you can get access to all my content. At the top of the site, there's a link for the newsletter. You can sign up for our free newsletter. And then our main service there, as I said earlier, is making information actionable, right? So for most people, and this will be my last parting bit of advice, if you're going to get into the investing side of things, right? We talked about earning, we talked about saving, we talked about investing. Really, one of the first questions you have to ask yourself as an investor is, all right, am I going to be a do-it-yourself investor? Am I going to be the one who's going to be, building my portfolio strategy and then actually building the portfolio itself and determining which assets to buy, and are they at a good price now, or should I wait? And how do I, own that security, and what hedges do I might want to have in place? And boy, something just happened in the world. Do I need to change my portfolio as a result of that? You want to choose, am I going to be a DIY investor who's going to take on all that responsibility about my money? Or am I going to instead focus my energies on finding the right financial quarterback to call those plays for me and to execute them for me? And honestly, I think the vast majority of people of any age fit into that second category. So part of this is, I think you just want to be honest with yourself, with your capabilities and where you are right now in your life. Most people, they're pretty busy, sometimes overwhelmed, dealing with their job, dealing with family, dealing with other things going on. And so, make that decision first. You're going to be a DIY guy, or you're going to use a quarterback. So on my site, if you decide, hey, I'd like to have a financial quarterback help me, we have financial advisors that are endorsed by Thoughtful Money. You can have a free consultation with them. It doesn't cost you anything. There's no commitment to work with these guys. It's literally just a free public service that they offer to help people determine how to best position themselves today, given their own personal, unique financial situations. And so while you're there on the site looking at my new content or signing up for the newsletter, if you think you might want to have one of those conversations, just input your email address into the site there. There's a short form to fill out. It takes you like less than 30 seconds. And then you can have a half-hour consultation with one of these guys. And look, it's just good information, right? You can take whatever they tell you and you can decide to do it yourself. If you find that you have another financial advisor, this is just additional information that you can give to your other advisor if you like it. Or if you like these guys, maybe you might want to keep talking to them. So anyways, I just want to underscore at the very end there, it's all about putting information into intelligent action in your life. So no matter what you do, whether you're watching my videos, whether you're watching Ben's, whether you're watching somebody else's, or reading a book, or watching TV, or whatever, at the end of the day, that information is only of use to you if you apply it into action around your wealth. And yeah, I think it's about the most important thing I can say, Ben.
Well, I will be sure, to link that into the show notes. And once again, I want to thank you for making the time to be here today.
My pleasure. And look, folks, if you end up coming over and watching some of my videos, or going to my website where there's a way to contact me there, I love viewer feedback, period. And I listen to every single comment that's made on YouTube. I read every email that's sent to me, every direct message on Twitter. And no huge surprise, my audience tends to skew to the older side. One, because I've got some, white in my beard myself, but more just because wealth tends to be correlated with age. And we didn't even get into this, Ben, but I mean, one of the main reasons why I do what I do is I'm very concerned about the growing wealth gap in this country, and how not only is more and more of the spoils of the economy finding its way into fewer and fewer pockets, but the wealth gap is also accelerating on a generational basis. And I highly admit that it is a lot harder right now for millennials, and especially Gen Z, to build capital going forward. It's a tougher job market in general, and cost of living to income, that ratio is way worse than it's been for previous generations. So like, I feel very acutely, and again, I've got college age daughters of my own, so I see the world through their eyes too. I'm sure your viewers probably have the opinion that, hey, we've got a harder time building wealth than the generations that came before us, and sadly, I'm here to say that that's likely true. So anyways, because my audience tends to skew older, and I've got these concerns about wealth disparity, I particularly like to hear from younger generations, both in terms of what topics would you like to see addressed, in my interviews? What type of experts would you like to see on there? What are your key pain points? Because again, that helps me determine, solutions that I might be able to create content-wise or with our financial advisors that can better address the needs of the up-and-coming generation. So please reach out to me, folks. I'd love to hear from you.
I appreciate those final words there. Thanks again, Adam.
Hey, it's been a pleasure, Ben. Thanks so much.